Well, so our topic number 4 is simple interest, working with single payment and applications. Although we know that in the field of finance and economics, we calculate two different types of interest. One is simple interest, and the other one is compound interest. In this particular chapter or a topic, we are focusing only on the simple interest, not the compound interest. So let's start. What are the topics we're going to cover under this chapter? One is uh, understand the relationship between principal amount in a loan and then the rate at which we are charging the interest and the time period. So the what type of relationship these three variables have. And then we calculate moving money involves simple interest, and the application we can say that saving accounts and short-term guaranteed income certificates. So that's a one type of accounts normally people have with the banks. Then we will talk about promissory notes. That's a mode of financing between one corporation to another corporation or one firm to another firm. This is what we call it as a between the traders or between the businesses. The buying, borrowing, and lending is done through promissory notes. Sometimes we also call them as just notes. So in financial statements of corporations or businesses, you can find the word notes. Then we will talk about the simple loan. The loan people borrow or the corporations borrow from the banks and other financial institutions. And the best example for the students are the student loans. The students borrowed money from the banks. Treasury bills and commercial papers. This is a borrowing of a corporation or the government directly from the public. Now, if the government is borrowing from the public, we call it as a treasury bills. These are the bonds sold by the government and to the public in order to borrow money to do some projects and also meet their deficit in their budgets. But if these borrowing is by the corporations, and these corporations borrow money by selling bonds to the public, these type of bonds are called as a commercial paper. So it's a very same the like a treasury bills or the promissory commercial papers. The only difference between these two is that when a government is buying, we call it as a treasury, and we use the word treasury for government as well, like treasury benches when we are talking about the parliament. So those who are in government, those are sitting on treasury benches, and those who are against the government, they are sitting on the opposition benches. So that's the word treasury. We use the word treasury for the government as well. The world of finance calculates interest in two different ways, as I mentioned: simple interest and the compound interest. A simple interest system primarily applies to short-term financial transactions with a time frame of less than 1 year. In this system, which is explored in this chapter, interest accrues but does not compound. For example, if someone borrows $100 for 2 years, the simple interest is that you pay every year on that. If it is a 10% interest rate borrowing of $100 for 2 years, so simple interest says is that you have to pay $10 after the year one and $10 after the year two. That's a simple interest, like you pay, or you can pay altogether to $20 with the at the end of the 2 years. But if it is a compounding, then the calculations are a little bit different, because in the first year the investor earns, or the person who lends money earns $10 as an interest. Now the principal is considered to be 110. Then we have to calculate for the next year. The second year interest is on 110, not on the 100. And by this way, the interest is going to be $11. And by altogether, the total interest is going to be $21, not the $20. So that's a difference of a compound interest. So we can read here: a compound interest system primarily applies to long-term financial transactions with a time frame of 1 year or more. In this system, which the next chapter explores, or our next video, next topic is going to explore that, interest accrues and compounds upon previously earned interest. So interest on interest. So in a simple interest, there is no interest on interest, but in a compounding, there is a interest on interest. Now the simple formula, if I write it here, a very standard formula for calculating the future value, which is including the interest. So it's going to be present value into 1 plus RT. So here we see that for a simple interest, there is a at the moment, which we call also as a principal amount, and this is just a 1 in order, because at the end of the term you have to pay the principal, plus RT multiplied by principal is going to be the interest amount. So if we see we want to calculate just an interest amount, so this is going to be just the principal into RT, principal into RT. Now rate is a interest rate, and normally the interest rates are given on a basis of yearly, like 5% interest rate. So it means that it is 5% per year. Otherwise, if the interest rate is of a different time frame, then it should be very clearly mentioned, like it's an interest rate per month, interest rate per quarter, interest rate per half yearly. But if it is nothing mentioned, then we assume that it is for a year. Now these are four different, so as I mentioned in my previous formula, so if we write it like uh, I sorry IPRT. Now how many variables are there? So there are four variables in it. In this formula there are four variables. Now it's a mathematical rule that if in an equation, if we want to find out any variable, we need at least all other variables, the values of all other variables. Like if there are four variables, we need to know the three variables in order to find out the fourth variable. So in very simple, like we can calculate all these four variables if we know the value of other three variables. So in this our first question, we see here that we want to find out the time. Like calculate the length of time in months that it works. It takes to the money to acquire the interest. Like for how many months must 95,000 be invested to earn 1,187.50 of a simple interest at an interest rate of 5%. So what is given? Three variables are given: principal, rate, and the interest value. So what we want to calculate? Time. So let's start and see that how we can do this very quickly. So let's start on the go to the next page, and we see here that the given information is P is equal to 95,000 and R is equal to 5%, but it is per year, right? And I is equal to 1,187.50, right? What we want to find out? T. So the formula is saying I is equal to PRT. So if you want to find out T, then I divided by PR. So what is I? 1,187.50 divided by what is P, which is 95,000, multiply by, now there is a catch in it, because this 5% is in year terms, so we have to divide it into 12, so that is going to be on a monthly, because we want to now figure it out the time in terms of months. So we see here, we get it, the T value is 3 months. You see, this one is important to note, that we have to convert the interest rate into per month in order to calculate the time period in months. The second part is saying a 3,500 investment earned a $70 of interest over the course of 6 months. What annual rate of simple interest did the investment earns? So here what we know principal is 3,500, interest is $70, time is 6 months. And what we want to calculate is we want to calculate R. So how we can do this? R is equal to 70. R is equal to 70 divided by 3500 multiplied by 6 by 12. Why? Because you want to find out the rate per month, and if you find it out, you get it 4%. So what annual rate? So we want to find out annual rate, and the time period is in months, so we want to convert it into annual, so that's why we divide it, and this is our per annum rate. The next question is saying what amount of money invested at 6% annual simple interest rate for 11 months earn 2035 of interest. So in this case, what we want to find out, the third one is we want to find out the principal. Interest is 2035. Interest rate is 6% per annum, and the T is 11 months. So how do you figure it out? Like P is equal to 2035 over 6% into, or we can write it like 0.06 into 11 by 12. So if we calculate this, we can get it a 37,000. So we need to invest 37,000 for this period in order to get 2035. Julia borrowed 1,100 from Maria 5 months ago. When he first borrowed the money, they agreed that he would pay Maria 5% simple interest. If Julia pays her back today, how much interest does he owe her? So in this case, we want to find out I, and the principal amount I, we want to find out I. The principal amount is 1,100, right? The rate is 5%, or we can write 0.05 into for 5 months, so 5 over 12. So we get it, if we find it out, that how much it is, and the interest rate is $22.92. So we see here there is a one formula that is for interest rate, interest income. I is equal to PRT. There are 4 variables in that formula, and we can find it out any variable out of it. One more thing here we are finding out, which is important to understand. Azul borrowed 4,200 from Hannah on November 3rd, 2011. Their agreement required Azul to pay back the loan on April 14, 2012 with an 8% simple interest. In addition to the principal, how much interest Azul owe Hannah on April 14th? So you see here, it's not like a month or starting from the very beginning of month. It is in between 2 different dates. So in this case, what we have to calculate, we have to calculate the number of days, and by this way we are able to figure it out, the exact interest rate. So if I do in November, because the contract is starting on November 3rd, so in November, how many days the loan was outstanding? 27 days. And similarly, if we go for December, it is 31 days, because December has 31 days. And for January, we still have a 31 days, right? And for February, we have a 29 days, because 2012 is a leap year. And then in a March, we have a 31 days. 31 days, and then in April we have 14 days. And by this way, if you find it out, we can get it 163 days. So how we can figure it out? You see that the interest rate is 8% and the amount is 4,200. That's the interest we want to calculate, and the interest rate is 8%, but 8% is for the whole year. We divide it with the 365. Why we are dividing with 365? Because we want to know per day interest rate so that we can multiply it with the 163 days, and we get it by this way. The amount is 150.50. So this is our interest. So this way we can say that we when the period is broken between the months, so in that case we have to calculate the days and convert the interest rate into per day interest rate and multiply by that interest rate. Now there is a possibility that the interest rates can be a fixed or a variable, and normally when you borrow money for house in Canada, we get different types of loans offers with the different interest rates. Some are fixed interest rate for 5 years, some are fixed interest rate for 3 years, some are fixed interest rate for 1 year, and some are variable rate. That they gonna vary. Now how they variable is based on a benchmark, which is every 2.5 months after the Bank of Canada give their policy rate, and that rate is the benchmark, and over and above the banks calculate their variable rate. So fixed rate interest rate is an interest rate that is unchanged for the duration of the transaction, and variable interest rate is an interest rate that is open to fluctuate over the duration of the transaction. And the variable interest rate is usually tied to the prime rate, which is an interest rate set by the Bank of Canada that usually forms the lowest lending rate for the most secure loans. So we see here when we want to calculate the simple interest for single payments, as like is a single payment principal. I wrote this formula in the beginning. Like again, there is a 4 variables that what we want to pay, multiply by the principal what we are borrowing into 1 plus RT, where I is an interest amount. How do we get it? S minus P, the difference between the amount we are paying back minus the principal what we borrowed. So difference is definitely the interest. Now the banks also have a different types of accounts, and what the most common account with the banks, almost all of us have a account with a bank, and the banks holding for a common or a general public is saving accounts. A saving account is a deposit that bears interest and has no stated maturity date. There is no expiry. You deposit it and you can keep it as long as you want. So these accounts are found at most financial institutions such as commercial banks. Owners of such accounts make deposit to and withdrawal from these accounts at any time. Usually access the account and at an automatic teller machine, ATM, at a bank teller, or through online banking. So they're all the means we can use to withdraw the money or use the money from our bank account, saving bank accounts. There is another one we commonly people deposit, those who want to get some money every month or every quarter. So a guaranteed income certificate is an investment that offers a guaranteed rate of interest over a fixed period of time. In many countries around the world, a GIC is often called a time or a term deposit because it's for a fixed period of time. And GIC are found mostly at commercial banks, trust companies, and credit unions. Now, what are the benefits or other drawbacks of these two savings and short-term guaranteed income certificates? So there are many options for investing your money that are safe and secure, particularly saving accounts and short-term guaranteed investment accounts. Certificates. Some of the benefits and drawbacks associated with the safe and secure investment are listed in the table below. So what are the benefits? Investments are virtually 100% secure or safe, uh, and means that the chance of losing your investment are almost reached to zero. They always have a positive rate of interest. You get some interest on your account. So it is easy to access the money when the investors need it. An interest rate earned is better than zero interest rate, and it is suitable for small amounts. So these are the benefits. What are the drawbacks? Interest rates are extremely low and offer little growth for your money. Many comes with a stiff fee and interest rates. Penalties of certain conditions are not met. If you withdraw before the maturity date of that term deposit or guaranteed income certificate, and then you have to pay the penalties. So minimum balances are a common requirement, otherwise the interest rate is zero, and balances are only insured up to $100,000, not more than that. So here is an example. The RBC high interest saving account pays 0.7% simple interest on the daily closing balance in the account, and the interest is paid on the first day of the following month. On March 1st, the opening balance in the account was 2,400. On March 12th, a deposit of 1,600 was made, and on March 21st, a withdrawal of 2,000 was made. Calculate the simple interest for the month of March. Now you see here there are three different changes in the account. Initially the account was started with this balance, and then there is a deposit, and then there is a withdrawal. So it means we have a different balance in different dates. In this scenario, normally what we do, we calculate the daily average balance, which is the end of the day balance, and apply interest on it. So daily product we calculate it, but here we have a very simple 3 dates on which we can calculate these figures, and we see. So let's start, and so we can see that between March 1st to first withdraw deposit is 12. So 12, how many days are these? Are 11 days, right? These are 11 days because we have to subtract. 12 is not counted. On 12 the balance is more, so we get it 11 days. Now for 11 days we have a balance of 2,400. Multiply by how much is the rate of interest? 0.075 into divided by 365 into 11. That is for, and then from March 12 to March 16 or 21, March 21, we have a 9 days, and these 9 days we have a 4,000 balance because we deposited 1,600 deposit. So we have a 4,000 balance into 0.075 over 365 into 9 days, and then from March 21 to March 31. And how many days these are? These are again 11 days, and now there is a withdrawal. Withdrawal of how much amount is $2,000. So remaining balance is 2,000 into 0.075 over 365 into 11. So we get it this much. Now if we figure it out that how much money we have it here, we get it like $0.542,465 here, $0.739 726,726, and here we have a dollar 0.452054, And altogether, if I write it here, total interest, which is the sum of this plus this plus this, so we get it 1.73. That is our interest over this saving account. Then comes the promissory note. Promissory note, as I mentioned, are a borrowing tool that allow both companies, businesses, and people to get, and people to people or business to business, get finance from a source other than bank. The money is borrowed from other people or companies who are willing to provide the financing. The Bill of Exchange Act defines the promissory note as an unconditional promise in writing made by one person to another person, signed by the maker, engaging to pay on demand at a fixed or determinable future time, a sum certain in money to or to the order of a specified person or a bearer. So promissory notes are commonly referred to as a notes. Now these are the examples of a promissory note. But one thing in the promissory note is that we have some grace period. So when we are calculating the interest, we ignore the grace period. But when there is a payment, there is a 3 days grace period. So here is an example like we want to see. On April 30th, 2001, Barney purchased some furniture from Fran Fine Furniture on a 10-month no payment loan. A promissory note was created, established an interest rate of 11%, and it includes the clause no grace period. So the furniture purchase was 2,234.40 on August 12, 2011. Fran Fine Furniture sold the promissory note to an investor at an agreed upon interest rate of 13%. What was the proceeds of the sale? So, in this particular question, the important thing to note is that promissory notes are saleable instruments, and we can sell it to another party, but the other party is going to be, like in this particular example, the furniture shop sell the furniture on credit, but later on he needs money. So what they said that, okay, we want to sell this promissory note, but the interest rate is a little bit higher to pay, so that the buyer is going to get it a benefit or a spread amount as an income, and there is a more cost involved if you want to take this opportunity to get discounted. We also call them as a discounting of Treasury bills or discounting of promissory notes. Discounting of promissory notes or factoring of bill receivable or notes. But here we are saying it's a discounting of promissory notes. Now, the important thing you have to remember in this case is there's 2 steps involved. One is that we have to calculate the number of days between 2 dates. So the first we calculate here some, and then we will move on to the next. So we have to calculate the date from April 30th to August 12, and then we have to calculate the date from August 12 to, now it's a 10 months promissory note. So and it's written on April 30th. So May, June, July, August, September, October, November, December, and January. So January is going to be the last day. Again, we see May, June, July, August, September, October, November, December, and January, February. So February is the 10 is a February, right? So February 29, which is again 2012 is a leap year. So we're going to calculate it. How many days are there in both the periods? So in the first from April 30th to February 29th. So April to, sorry, we have to calculate for February 29. Is going to be how many days? Is 305 days. And between August 12 and February 29th is 201 days. 201 days. So these are the days from April to the February. This is the whole period of the this promissory note, which is 307, and the broken period in which they discounted is 201 from 12 August to February. Now, what we want to calculate, we have to calculate the future value of the bill, and the principal amount here involved is 2,234.40 into 1 plus R. Now, in what is R in this case? 11%, right? The initial is 11% and then it is 13%, but we want to find out with an 11%. We convert this days into year because 11% is per year. So we apply this formula and then we calculate it. We get it like 2439.78. Now what we want to do, we want to calculate the principal with this value, which is the future value, because the investor who buy this promissory note is going to get this value divided by 1 plus 0.13 into 201 over 365, and if you calculate it, you get it 2,276.79. So this is the amount. So what were the proceeds of the sale? This is the proceeds of the sale. The furniture company is going to get it by selling this promissory note. Now we see also the loans. A demand loan is a short-term loan that generally has a no specific maturity, can be paid at any time without any interest penalty, and where the lender can demand payment in full at any time. It allows borrowing when needed and repayment when money permits, subject to the following 6 characteristics. There is some limit, like what we call it as a credit limit for this loans or a demand loans. Variable interest rates. Interest rate varies according to the benchmark rate. Fixed interest payment date. But the payment date for the interest amount is fixed, that you have to pay the interest on that particular day. Interest calculation procedure. Interest is always calculating using a simple interest procedure based on the daily closing balance in the account. Securities. Loans can be secured and it can be unsecured as well. Like secured means that there is a security against the loan. Like if you borrow for a house itself is a security. If you borrow a loan for car, the car itself a security. But when you borrow money from a credit card, there is no security. So there are certain types of loans in which there is a security, and we call them as a secured loan. If the borrower failed to pay, the bank has a right over those securities. And there are some unsecured loans, like a credit card, I gave you an example, or a personal loan type of things. There is no security; these are unsecured, and there's a lot of difference between the interest rate. For a secured loans, the interest rates are normally low, and for the unsecured loans, the rates are very high. Like for a credit card, the rate is almost 22.99%, which is very high as compared to other loans. Repayment structure. The repayment structure of the loans are also vary depending upon the nature of the loan. Like for a mortgage, the repayment loans are fixed monthly payments over a period of 25 years. For a car loan, fixed payments, monthly payments over a period of 3 years, 5 years, 8 years. But there are certain loans like running finance or a personal loans. You can pay and you can adjust any time, and the balance is going up and down continuously. So these are the example. While many types of financial tools use simple interest, there are 4 most common: personal line of credit, home equity line of credit, operating loans, and student loans. Student loans are specific to for education purposes. The government of Canada or any provincial government give a certificate to the student to apply for the student loan from commercial banks. So there is no security in that loan, but the government make it sure that okay, we will pay if the student is not paying. And during the education period, the student has not to repay that loan. The interest amount is paid by the government, And after completing education, after a 6 months grace period after education, the student has to pay the interest as well as the borrowed amount, which we call it as a student loans. The last thing is the Treasury bills. The answer lies in a Treasury bills better than T bills, which are short-term financial instruments that both federal and provincial governments issue with the maturity not no longer than a year. Approximately 27% of the national debt is borrowed through T bills. So all types of government, federal, provincial, and local, they all borrow from the public with the bonds, with the selling bonds, and these are called as a Treasury bills. But the most common one in our economy is the federal government. The commercial paper, or a paper for short, is the same as the T bills, except that it is issued by large corporations instead of a government, and it is an alternative to short-term bank borrowing for a large corporations. Most of these large companies have solid credit rating, that they get rating from the rating agencies, and they show that we are the best, and we are performing so well in the past, so if you lend us, we will give you a high return. So means that investor bears a very little risk that the face value will not be repaid upon maturity. So these are the two examples we gonna go over to understand this idea of a Treasury bills. So Government of Canada, 182 days issue T-bills, has a face value of 100,000. Market yield on these T-bills are 1.5. Calculate the price of the T-bills on the date of issue. So what we have to do is to calculate the price of our T-bills on the date of issue. So what is S in this case? S is 100,000. So at the maturity, the investor is going to get 100,000. Now, what else is given? Like rate, interest rate is given. So R is 1.5%. And its a time period is given as 182 days. 182 days. So what do we want to calculate? We want to calculate the present value. Right? So you remember the formula? So we can apply that formula, like P is equal to, so the formula is saying S is equal to P into 1 plus RT. So P is equal to S over 1 plus RT. So we can divide this $100,000 plus what is 1 plus 0.015 over 365 into 182. So this overall we can say that it is 99,257.61 is going to be the price of the this bond. Next, the commercial paper. Pfizer issued a 90-day 250,000 commercial paper on April 18 when the market rate of return was 3.1. The paper was sold 49 days later when the market rate of return was 3.63. Calculate the price of the commercial paper on its date of sale. Now it's again very simple. I'm gonna solve it here, because there's no space there. Now what we want to calculate, again, the price of the commercial paper. So is S over 1 plus RT. Now what is S? 250,000, and then we have to divide it with 1 plus what is R? R is in this case is 363, and divide it with 365 into now we days, how many days is going to be left? 51 days? No, 49. 41 days. 90 days. So yeah, 41 days. So when you apply, you get it the value like 248,984.76. So this is the value of this Pfizer commercial paper as compared to what we discussed in this example, which is a T-bills price. So this is all what I want to discuss regarding the simple interest. And if you have any question, please write it down below the comment section. And please don't forget to subscribe if you like it, and also press the like button. Thank you very much.